That.
Hey everybody. Hey, how you doing? Hey. Welcome to the live stream. You guys are awesome. Paul, what an incredible welcome, Paul, my dear friend. You just got done pooping. Welcome. You almost maybe didn't make it to the show, but he's
ran
here.
In the door.
He ran in, folks, just for you.
I thought we had like 10 minutes left. And I'm on Bumble, so I'm swiping, and I was gonna look up like, oh my god, I got 4 minutes. I was like, crap, I gotta go.
He's bumbling and pooping.
What?
That's just funny, bro. I mean, that is funny stuff. Listen, I should not be so upfront, because if you're watching this channel, I see the OGs on the chat and we love you. But Paul, there's so many more OGs.
Yeah, we've really blown up in the last. So since our last live stream, we're up like 60% in terms of number of subscribers.
So like at this time last week, folks, we had like 20s. We were below 3,000, and on Thursday we hit 3,400. We're now at 5,400 subscribers. Welcome to the 2,000 more of you who decided to subscribe to our channel. We certainly appreciate it. A little backstory is Paul and I have been sitting in this room for over 2 years now, Paul, doing this religiously, more religiously than we're religious, actually.
Yes.
And it's really been paying off, and a lot of our OG fans here this week are congratulating us, and we love you. We will go over a lot of things today. We want to do just a general stock analysis. We have Patreon stock requests that are straight from our Patreon page. If you want to join Patreon, the link is below, and I think if you watch for the next, our average is 17 minutes. If you give us 17 minutes, you'll want to be a patron after this. But Paul, give us your general thoughts on just the success of the channel and your last bowel movement and things that have been going on in your life. Go, baby, I love you. Go.
Well, it's been awesome. The Pfizer video is what really hit it big for some reason. The previous one was AT&T. This one is Pfizer, and it's getting us like 350 subscribers a day. It's been awesome. We get a lot more traffic, and we've also increased the number of videos we're doing now. We're doing twice a day, some sort of video, 1 o'clock and 7 o'clock Eastern time. The Patreon group has grown big time. So check out patreon.com/everythingmoney for more access to other people who are like-minded. And if you go to the highest tier, you get direct access to Trader Mo and I.
And what does that access give a patron? What does that get access to? What does that give them?
You can ask me anything. I mean, I talk every single day with Mo about our investments, our investment ideas. We talk about the analysis. Like today, we were talking about Intel more with one of our most devout followers, Phoenix, who's a great researcher. And he did a lot of research on Intel. So these are the things we do. We want to create this like-minded thought process of investing, do more research, understand more. We're building the Everything Money /8 Pillars website and potentially app that'll do everything that Y Charts does, and also offer the 8 pillars for every single stock we do.
We welcome in a lot of our new viewers. Jason, I see you there. Nathaniel, Tank, I see you there. As always, our dear friend John Thiesing is there. Living Alone, welcome. My son, George Kerchan, will be answering all of your stock questions on the chat. He's 10 years old, and he knows a lot more than your investment broker that you're probably hiring right now. And is Trader Mo going to be on the chat today, Paul?
Yeah, he's down there. Trader Mo's in Florida. He's meeting us in Mexico. He's meeting me in Mexico on Saturday, but he's in Florida right now with his family.
So we have got some, Edward, I see you there, and Angelos, I see you. We have got a lot of feedback that if you're just, as we're analyzing a company, if you're not that interested, the chat is very rewarding for some people, and there's a lot of information there. If you have any questions, you can ask our partner, Trader Mo. He's really good at this. And of course,
even on the Patreon gets you the website and app for free, but you also have people to chat with about your investment ideas, etc. So it's well worth it. It's growing. We have 85 subscribers right now, and we're going to shut it off at some point when the website comes up, or we will make it more expensive because we want to reward those who signed up early.
My wife is watching. Of course, David S. Pumpkins is watching. Benjamin, a couple of our patrons, and Gavin Mayo, Gavin_Mayo. He's on there.
Oh, he's got a great
TikTok, a young TikTok show about investing, very similar to some of the lines that we're saying. All right, guys. Paul, shall we get going? Alkali, I see you there. It's great that you guys found
So our plan today is we take only stock requests from our Patreon members. Don asks the day ahead of time, and we come up with a list of things we're going to look at. We did a couple stocks already today, but we're going to go through these things, and we're going to go a little bit slower so we can explain things a little more thoroughly hopefully. Keep the questions coming. Seth will try to sift through them. Seth, can you pay attention to me and the user at the same time?
I'm going to try. Jason said he sold all of his Tesla because of Paul's Tesla rage. Jason, I agree with you. I had a lot of Tesla. My son's made good money on Tesla, Paul, but he's begging me to sell. There he is right there. So he's begging me to sell a couple shares of Tesla he has and get out on the top end of it. So shall we get going, Paul, with our 8-pillar analysis? Folks, if you're joining us, we do this 8-pillar analysis looking at the health of a company. We do not look like this. We do not solely look at the stock price. We want to look at the financials of the company, trust the math, not the hype, Paul, and see what's going on with some of these companies. Should we get going, my friend?
I do think with Tesla, let's talk about Tesla real quick. I think Tesla entering the S&P 500 was the last piece of good news.
You said this yesterday.
Apart from them crushing and all of a sudden getting 50, 60, 70% growth for years to come, it's the last bit of, that was the last kind of what's the big demand going to happen in the stock. And I think it's hit. So what do you do now? I don't know. Maybe I've been wrong a million times on Tesla. This year it's up like 500%. I have no idea what to say besides, more power to you. But I think it's just it's a very tough time to make a value investment in Tesla.
Okay, our first company we're going to look at today, Paul, is from Llewellyn. Llewellyn's from the UK. I think he's watching now. It's almost bedtime for him, Paul, so we better get to his first stock, which is Capri Holdings, CPRI. Do you have it up there?
Yes. So Capri Holdings owns Michael Kors, Versace, Jimmy Choo. It also looks like they have, it looks pretty good. So it's a big high-end retailer. There's another one, Louis Vuitton. They're a higher retailer that's foreign. This is not based in the U.S., so let's start checking it out.
Now, I know you have a Gucci belt when you go to bed in your PJs. Yeah. You're very into this stuff.
The funny thing is, the one thing I don't spend money on actually is clothing. So that's the funny part about
That is true. You get all fired up about Nordstrom Rack and sale clothes.
Well, the reason being is I'm a big believer in you spend money on the things that matter, and the clothing doesn't matter to me. It's like the other stuff, like watches and stuff like that.
Here we go. Let's look at what is the market cap for Capri.
So $6.3 billion. So remember, guys, this is the amount of money you pay to own the company in full. You don't look at the stock price. I haven't mentioned the stock price yet. I haven't even looked at it. I couldn't guess what it is. It's the number of shares outstanding times the stock price. So you're at $6.3 billion to buy it all out.
Pillar number 1 is PE ratio, which is price to earnings, and we want this less than 20, Paul.
It's non-existent. They've lost $400 million in the last 12 months.
You can see that, right? That was coming, right?
Yes. Now, so it's an X, but it's not a bad one because due to the recent downturn, I'm sure sales of higher end goods have probably gone down a lot. But in the last quarter, they have an 11% profit margin. Check mark there.
That's pillar number 2. We want the profit margin above 10.
And the big thing is high-end goods, 64% gross margin. So they have a very high gross margin. For every unit they sell extra, they make 64% of that in bottom line profit.
Pillar number 4 is profit margin over the past 5 years.
I already did that, 11%.
I'm sorry, my friend.
I already did 11% over the last quarter. It's growth, revenue growth.
My apologies.
No problem. $4.7 billion. It fell a little bit, and we're at $5.6 billion. So check mark there.
I was trying to get that last comment out before I was coughing up a lung, so I really rushed through the first 3 pillars.
That's okay. Now keep in mind they did buy Jimmy Choo and Versace in this time period. So I don't know how much of this growth is organic growth, like internal growth, versus making acquisitions. There is a difference. You want to be able to see. I remember once I'm going to an investment thing, and a guy was bragging about how they got 80% growth in their company over a 10-year period annualized. I went to him afterwards. I'm like, how'd you do that? He goes, acquisitions. I'm like, okay, that's not the same thing, but I get it. So it has been, you have to watch for the acquisitions, and we can look at that later in the cash flow statement.
How about profit growth? Pillar number 4, profit growth over the past 5 years.
Okay, so profit growth is an X because of the loss from 839 down to loss of 223. But the thing I'd want to focus on mostly is this is the first quarter of 2020 was our last fiscal year. So it's kind of, it's kind of surprising. Let's look at their last 12 months.
Make sure you all are tickling the thumbs up. We really appreciate it. And if you don't like what Paul's saying, you can give that thumbs down a little tickle. Paul likes those too. Both tickles. He's in favor of. You know this. If you've been watching the show, you know that Paul loves to get tickled. And so with that said, make sure you're smashing it. Go ahead, Paul. Do your quarterly. Your boring numbers. Go ahead.
Last quarter of last year, they had profit of $210 million, and they lost $550, lost $180. In this last quarter, they're back to profitable. So that's something that's showing, okay, they're coming back into profitability here. And in terms of revenue, I'm going to look at revenue comparison. And this is important to do in certain stocks depending on time frame. So this last quarter, they did $1.1 billion. The same quarter last year, they did $1.44. So their revenue is down about 30%, but they still showed a profit, which is a good sign. So things might be turning around for them.
Are we on shares outstanding now?
We are.
Pillar number 5 is we want the number of shares outstanding.
So we want it to be decreasing, and it has been decreasing. 186 to 150, big check mark there. That's a 20% drop in shares outstanding.
Why is that good, Paul, for our new viewers?
When you own a share, when they buy their shares back, you still own, let's say you have a company with 10 shares and you own one of them. You own 10% of the company. If they all of a sudden buy back 2 shares, there's only 8 shares outstanding now. You now own 1 share of 8, which is 12.5%. So they've essentially given you more ownership of the company by you just being patient. So we like that. We like that to a certain level, but in this situation, overall, I don't like seeing shares going up because the exact opposite occurs then.
Pillar number 6 is current assets greater than current liabilities. Paul, we want them to be able to pay their bills.
Current assets is $1.63 billion. Current liabilities is 1.58. So it's a check mark, but barely. But it is a check mark. So that is a check mark there.
Pillar number 7. This one's very near and dear to your heart, which is the free cash flow growth, Paul. You want that free cash flow growth over the past 5 years being nice and awesome.
Okay, so here we have about 870 million, and recently we had 640, call it. So that's an X there. Okay. Now, obviously, this 1 year included the big loss in the first quarter, but let's do the average over the last 5 years. So it's 870, and then 830. And then 880, and then 510, and 640.
The average free cash flow is about 750, Paul.
Okay, so 750. So guys, here's where we talk about what number we multiply by. This is all dependent on growth. We see declining free cash flow. Does that mean that's going to happen for the future? I don't know. That's part of the extra research you need to do, because the multiplier we picked there is based on the future prospects. If you see a lot of growth potential in the revenue and profit, you're okay adding extra, doing a higher multiple of price to free cash flow. I think in this situation, you want to keep it around 12 or so. So that's $9 billion.
Yeah.
And what are they currently selling for?
$6.3 billion is the market cap.
$6.3 billion. Guys, this might be something to look at.
Wait a minute now. Beth, my wife, Beth, Gio, my son, get your pens ready. Get your open up your Fidelity app, Paul.
Yep, so this is $6.3 billion is currently selling for. And I'm talking about, so this is currently selling for about 8.5 times free cash flow.
This doesn't happen often on our show,
Does not happen
folks.
often. So this is actually pretty good, guys.
So let's regroup. This is Capri Holdings. Their PE is non-existent. Their profit margin is good. They have revenue, but not profit growth. Their shares are decreasing. Assets over liabilities was good, Paul.
Current assets over current liabilities.
Free cash flow is not so good.
Now it's declining, but I put a low multiple in there. Now here's what the things, so somebody's gonna sit there and go, oh, is Paul buying? Now, what we wanna do is we wanna sit there and determine, are we doing more research into it to determine if we wanna buy? Right now, the multiple, here's the point I'm making. When people say, oh, Paul only cares about income, this company lost money in the last 12 months. Lost a lot of money. But I see the turnaround happening. The last few quarters have been getting better. This has future potential still. Let's see what the last 12 months of free cash flow was. That'd be a good indicator to see. They even had free cash flow, even though they lost money in the last 12 months, they have free cash flow of $580 million. So it's currently only selling for about 12 times, not even 12 times, 11 times free cash flow in the last 1 year. And that last year included COVID. So I think there's a lot of potential here. Those are good brands. I would take a look at those brands. How are they doing overall? And see if this is a company that can become like Louis Vuitton, which is, I mean, Louis Vuitton is a very high end, very, very high end. I mean, Louis Vuitton's so high end. They don't, if they over manufacture products, they burn it. They don't have a discount area. They don't do anything. They just burn it.
You do that with money. I see at your house out back there, a little bonfire. Llewellyn is taking his victory lap. One of our patrons suggested this company, and he's getting congratulated in the comments. David has an interesting question. David says, if you ever want to buy a stock because you feel it's overvalued, why not just buy a fractional share of that stock? Would that be worth it, Paul? Does that make any sense?
So I look at buying one share as buying the whole company. I know people have a hard time understanding that.
I do. I have a hard time understanding that.
But to me, you're buying a piece of a company, so you have to value the whole company as a whole. I don't believe in buying fractional shares. Now, what I might do is I might sell options on that to buy it at my lower price, but I'm never going to buy shares just because. I mean, if it's teetering on where I want to buy it at, maybe I start a position. If it goes lower, I keep adding to it. But I'm a very disciplined guy. where I want all of us to become more disciplined, where we're sitting there and focusing on buying the companies that we want at the prices we want. And that way that as a company, if you bought this Capri company at a low price and you had the last year happen, but you still did the numbers and going, hey, as long as they rebound, they're still worth, would you care? No, you'd be like, okay, this is good. That's the way I want to do my investments. It's few and far between.
Looking at this quote, at what point, Paul, do you look at the general graph that everyone else looks at, which is just the price of the stock? When do we look at?
The only time I do that is if I see a company that is selling at a price that's very attractive and my value is a lot higher, I'll get a little concerned. For example, eBay, I have worth like $75 and it's never been to 75. That's a concern for me going, well, why has it never even been there? Like, it's not even been close to that. So those are the only times I ever look at the chart. But here, guys, I mean, the peak was 100. It's at 42. It's probably, I mean, I have to do more. I know everybody hates hearing this. I have to do more research to understand, are they going to be back to a growth path where I can sit there and say, hey, I don't need massive growth. If I just buy this company and their free cash flow is stable at $750 a year for the next 20 years, happy camper. Because I'm paying $6 billion for a company that I'm going to generate all this cash flow for the next 20 years. It's very, okay, this is great.
That's definitely an interesting way to look at it. And I think a normal person like myself, I've never looked at a company like that until I met you and have learned from you, Paul.
Thank you.
I would say I'd like to pause for just a brief moment and thank all of our watchers out there. We just hit, for the first time, Paul, Don, with all of your incredible work this year, and our intern, Nate, we just hit over 100 people watching the live stream at one time, folks. I've said this before. If you're new, I can't think enough. We had 87 subscribers at the beginning of this year, and a lot of this time for the past 2 years was just Paul and I talking to ourselves in a room with very few people watching. So the fact that we have over 100 of you watching right now is incredible, and the support really melts our heart. Paul, it's becoming you and I's like a daily thought pattern, night and day. Is just this show, how to make it better, how to please our patrons, and it's been quite incredible. So I appreciate the support, and as always, make sure you guys are tickling that thumbs up. Paul,
we have 108 people watching, only 59 likes. Let's get on this. Come on,
Paul's gonna get salty if that stays low, guys. So make sure you're giving a little love to that thumbs up. Paul, should we keep going? Yeah,
so that's a company that I want to sit there and Trader Mo, we should take a look at this company.
And Gio, my son, we should take a look at that company. I don't know what we'll look at, but we'll do it. Okay. We've gotten multiple people ask for SpartanNash company. This is from David, our patron. This is from John Thiesing, our patron.
Okay. As soon as I saw food distributor, I thought low profit margin.
Well, food distribution's getting, tattooed chef is like, this is getting to be a thing now. I'm not surprised someone wanted to see this. And what I see is a very low stock price, not number, but maybe in comparison to what it used to be, not very low, but I mean, it's definitely down. So I'm interested in, I guess you've trained me to maybe look at more companies that are more down, right? We don't want to look at them as they're flying up. We want to look at them as when they're kind of down.
Right. So they're a multi-regional grocery distributor and retailer, operates in the United States, segmented into military, food distribution, and retail. Its military segment consists of distribution of products to the U.S. military commissaries. Okay.
What is the market cap for this company, baby?
$600 million. So it's one of the smaller companies we've looked at.
600 mil, okay.
Yep, but PE ratio, 8.7, check mark there.
Okay, PE check mark. How about profit margin, Paul?
Okay, profit margin's awful, 1%.
Oh, Lord.
Yeah, and in the last 12 months, it's even lower than that. It's like 0.75%. So it's an X there, has a big dividend. So 4.5% dividend on $600 million, you're looking at $27 million in dividends per. Did I do that right? 1%? Yeah, around $27 million in dividends per year. So we have a check mark and an X, and we have $27 million in free cash flow that we need to be able to get to pay that dividend. Because free cash flow, one of the uses is paying out dividends.
Let's look at, sorry, Paul.
Revenue growth.
Revenue growth. Thank you. Pillar number 3, revenue growth.
Okay, 7.65, 8.5, check mark.
Nice. Alkali's saying they do stem cell research as well. That's
That's random.
Strange. Okay. Keep going, Paul. Let's go profit growth over the past 5 years.
X.
62
to 5.7. But that's interesting. That was 2019. I wonder why that happened. Because they were, I mean, look at this. They did 63, 50, 57. They lost 53, made 35. So it's inconsistent. So guys, when we talk about inconsistency, it's really important, in my opinion, that when profit is inconsistent, you pay a much lower multiple of cash flow and PE, because you don't know what you're going to get here and there. It could be 1 year you have a $57 million gain, you give it all back the next year. So in 2 years, you made no money.
This is SpartanNash, which is American food distributor and grocery store headquartered in Michigan. Paul, keep going on your pillars there. This is pillar number. I have no clue. I lost track.
37 million shares. Those are 35. So
Oh,
check mark there. I'm pillar number 5.
Pillar number 5 is check mark. So they're buying back shares?
They're buying back shares.
Oh, that's nice. Okay. How about pillar number 6, which is current assets greater than current liabilities?
So the current assets are 1.1 billion. Current liabilities 695 million. Check mark there.
Oh, nice.
And they only have 1.6 in total liabilities, which is good because a low profit margin business, it's hard to have a lot of debt in there.
Let's look at free cash flow. This is the free cash flow growth, cash from operations minus capital expenditures over the past 5 years. We're going to get an average of this.
Okay, so it was 142, and last year it was 105. So X for growth.
Oh, boy.
And the average is 80. So 83 is one, negative 22, and 100.
Negative 22. Oh, my gosh. Oh, my gosh.
So this is the inconsistency I talk about, guys.
Plus 105 minus 22 divided by 5 is 81. 81 is their free cash flow.
81. I hate to say this, guys, but
come on.
I mean, this actually doesn't look bad. You're basically paying 8 times free cash flow for the company right now.
Market cap is 600 million.
Yeah, you're basically paying less than 8 times free cash flow. I mean, let's look at their last 12. I mean, this is 2 in a row now that have hit our metrics. But here are the concerns I have with this company.
Okay, go on.
Well, first of all, let's see the trailing 12 months free cash flow. Oh, about 190 million. Wow. I don't like the low profit margin. Low profit margins just eke me out. Let's see what the average profit margin has been over the last. Seth, why don't you speak while I go to the other page?
You caught me off guard, but they're wondering where Trader Mo is. We'll get him in. RJ Wolf is asking for another company. He's asked about 17 times. RJ, I love you. We'll try and get to it.
So look at this. Let's look at this. This is my Excel sheet that we're going to input into the Everything Money and 8 Pillars app. It'll allow you to put your inputs in here. Right now, based on the average profit margin of the last 5 years for them has been 0.2%. It's a very, now my metric says it's worth about what it's selling for today. I'll be honest with you guys. I hate to say this. Even though all the metrics hit, I'm apprehensive about this because of this profit margin. I just hate this profit margin being so low. But that free cash flow is pretty awesome. That free cash flow is really, really awesome. Let's see here. Trailing 12 months.
Make sure you guys are smashing that thumbs up. We love you. And someone did smash thumbs down. We appreciate that as well. It must be because my camera crop could be adjusted a smidge. Look at this headspace, Paul. It's killing me.
It seems like they have. It seems like they have free cash flow the free cash flow is solid.
David says they're restructuring the military side of their business, which has been a drag on their profit, Paul.
And I do worry about, this is something like David. Is it David S. Pumpkins?
Yes.
We've got to do more research to understand what's going on with the military part. I'm not a huge fan myself personally in investing in something that relies on the government. Because at any given time, like Biden's coming to office now, Democrats tend to be less on military, less spending on military. Whether that's going to happen, I don't know. So you always worry about companies like this. What percentage of their revenue comes from the military when they're restructuring, et cetera. Now, does this mean you wouldn't buy a small number of shares and build on it as they get better? Yeah, maybe so. For me, for my personal opinion, I'm probably not buying this company because of the reliance on military and that low profit margin. That's my opinion.
David was the one, and John brought this up. Congrats, guys. At least thanks for bringing an intriguing one up. That was nice. Paul, should we move on?
Yeah. So that
was final take on SpartanNash Company. They have nice PE. Their margin is terrible, and they have nice free cash flow. How about Paul? I got another one here. How about Leggett and Platt?
What is Leggett and Platt? Sounds like a law firm.
Yeah, Leggett and Platt is I can never find the
based in Missouri.
Yeah, Missouri-based
designs and produces engineered components and products found in home, offices, retail stores, automobiles, and aircraft. 4 segments: residential, furniture, include components, machinery, steel infrastructure, furniture. Okay.
If you're watching this later down the road, folks, these are requested stocks for us, so we don't know anything about the companies. We get that comment, Paul. Why would you guys analyze this company if you don't know anything about it? Because we're taking these sometimes right off the request line. So if you're watching this vid, this is Paul's 8-pillar analysis on Leggett and Platt.
The other reason I don't do it research ahead of time, I want you guys to see my This is when this
Raw
first started.
thought
This is my
process.
raw thought process. Seth said to me, when you first hear about a company, what do? This is how I do it.
And actually, you're probably more drawn to not sexy companies, right? If it's all in the news and you hear all about it, you're probably not drawn to that one anyway. So
Of course.
what is the market cap for Leggett Platt?
5.5 billion, 24 PE. That's an X.
Oh boy.
9% profit margin. That's an X.
Oh,
Again,
0 for 2.
0 for 2, but we're not crazy terrible. 4%
Dividend
yield. By the way, the last company could easily afford their dividend yield, in case you forgot.
Oh yeah, their dividend was 4.5, Paul. So
yeah, it was $27 million a year. They could easily afford it. So 4% here on 5.5 billion is 220 million, roughly.
Okay, what is the pillar number 3 is the revenue growth for Leggett Platt
For the last 5 years.
last 5 years.
Okay. 3.9, 4.75. Check mark there. But if you look back here, 10 years ago it was 3.35. So there's not much growth happening per year. Nice, steady, boring company.
You love these.
I prefer them.
How about profit growth? Pillar number 4, profit growth, baby.
325, 333.8. Check mark there.
Carlos, welcome. He said he finally made it to a live stream. We welcome you in.
Oh, yeah, Carlos. I just mentioned it today.
And Edward is watching. Edward Milan
So we have a
is there.
check mark on the net income growth. And shares outstanding, 141 to 135 million. Check mark there.
Nice.
We have revenue growth, profit growth, and shares decreasing. So we have 3 checks, and we start off with 2 X's. So that's pretty good.
Leggett and Platt. We're looking at the current assets over current liabilities, Paul.
1.518 versus 947. So check mark there. Definite good check mark there.
Pillar number 7 is free cash flow growth, Paul. We want this growing, baby.
Okay, so cash from operations less capital expenditures. So we have 255 million versus 525 million. Check mark there. And then we also have 428, 273, 283, sorry, and 280.
The free cash flow over the past 5 years average has been about 350, Paul, million.
350 million. Okay. If you want to multiply, so this one is not growing a ton. This looks like a big jump here, but if you look at it, it goes from 255 to 428 down to 283, 280, 525. So I think 15 times is reasonable.
Why did you choose that number one more
because
time,
I look
Paul?
at it, the historical average of PE is 15, and over long periods of time, PE and free cash flow should be about the same. Earnings and free cash flow should be about the same. So if we're looking for an overall average, they have reasonable revenue growth, not a lot. They have reasonable free cash flow, even though this is a big jump from here. There's a lot of up and downs. So I still like the average. I'm looking at 15. Now let's see how the last. So it's 15 times 350, 4.5, 52, 5.25 billion, and it's currently at 5.5 billion.
Yes.
So that's a check mark there. But one thing I want to keep in mind: they pay $220 a year in dividends.
4% dividend, Paul.
Yeah, 4.5. So they're eating up a big chunk of their average free cash flow, but not of their most recent. So it's something to consider here, guys. It's not terrible. This is actually in the realm of possibility. So I'm actually like not upset about this.
Okay.
Question I have is manufacturing. What's their advantage in manufacturing? Do they manufacture here? Do they manufacture overseas? What's their deal? Yeah, this isn't bad. It's just, I mean, that gross margin's not very good, 22%. But you always, the guy who taught me, his goal is to find a reason to say no. I'm looking for reasons to say yes, because if I see a no that's so obvious to me, I'm immediately going, I'm out.
What are some of the obvious no's? A high PE, terrible free cash flow,
On
I
here,
assume?
like the thing is, that high PE, I think the earnings, we have to understand why the earnings and the free cash flow are so different, right? I don't like the inconsistency of the free cash flow, but I mean, at the end of the day, if you're looking at free cash flow overall, an average over 5 years, and let's see how the last 12 months have done in free cash flow.
Have we ever analyzed Berkshire Hathaway, Paul, by the way, not to change topics?
We have
but
not.
It'd be interesting to take a look at that. Thank you, Nick.
It would be. The last 12 months of free cash flow for them was $530 million. I mean, it's pretty solid. Yeah, maybe it's something different. I don't know. Maybe it's not bad at all. Let's see how their trailing 12 months have done in revenue. They're down in their revenue for the last 12 months. They still made money. Guys, it's not bad.
Now, Paul, you're obviously really pumping the ego of one of our patrons, David, as Pumpkins. He said he's 2 for 2 now, and he deserves a 3% commission on these buys if if you get into Charles Schwab right now and send some money their way. So we appreciate that, David.
Is Trader Mo in yet or no?
No. He must be. Who knows?
Are you serious right now?
We'd like to welcome a bunch of new people in. We welcome you to the show. Paul, we've hit over 120 watchers. This is really monumental and historic for us. We will be freaking out after the show is over and talking about this for the rest of the week. It's very, very lovely of you guys to join us.
All right. So, I mean, again, I don't know if I have to look at Leggett Platt more thoroughly. Internally, it's a smaller company. The question is their growth potential, et cetera. So, this isn't Leggett Platt, is it? Yeah, it was.
Yep, Leggett Platt. Yep.
By the way, John Thessing also asked for SpartanNash. Why is that?
Yeah, they're both on here. John, you'll get a 3% of Paul's take home this year as well.
All right, let's go to the next one. Any questions so far on this one?
Yeah, let's do this. Folks, if you're watching, let us know where you're watching from. We'd love to hear all of you folks all over the world. I would say, folks, if you're watching and you're just proposing some stocks, we have a list of Patreon requested stocks, and we like to please the people who love us first. And so if you're just jumping in and putting in a ticker symbol, I do love you, and we might get to it. But if you join our Patreon, we will certainly get to it. If not on the show, in the Patreon page. See, here comes everybody. UK, Lithuania, I love you guys. And yes, and Benjamin is correct, Paul. I was going to say that we've been prefacing all year that when we hit 10,000, you and I are going to wrestle, and we better get sized up for our singlets.
I'm going to tell you right now that I'm going to get my butt kicked by you.
Now, listen, we talked about me maybe tying my strong arm to my chest and just kind of left-handing it, a little bit. But the weight difference would be, I weigh about 265. What are you up to now?
I'm 180, 181, 182.
Yeah. Oh, sorry, you look like a 190. I'm kidding. And Benjamin said, Benjamin, I didn't know you were in Arizona. Great. Okay, guys. Here we go. Should we keep going, Paul?
Yep, let's go. Why is the Trader Mo just texted and said he's not coming on?
Yeah. That's a fail.
That's so sad.
And Gabriel's watching from Montreal, of course. Okay, guys, here we go.
Next company, EcoLab.
EcoLab. This is from Nosferatu, who's watching right now, I think.
Oh, he's messaged me a couple of times.
Yeah, great. You're here. I love you. Great.
They produce and market cleaning and sanitation products for hospitality, healthcare, and industrial markets.
I would imagine they're doing well this year.
So that's the thing. Automatic off the bat, I'm like, okay, they're going to have a big surge this year in revenue and profit.
Mm-hmm.
And I don't know if I'm going to continue that surge going, because the question becomes, is this a new way of life where all these products are going to be, is there going to be, I don't know if I'm going to be, I can't give the full value of their, I can't look at their recent surge and say this is permanent forever, because we've had a big surge to cleaning and products and things like that. But is that likely to continue once we get past the corona? Is it going to be something that's sustainable forever? I don't know.
They're definitely at the top of their peak in terms of their stock price. So usually you're already not in love with these type of companies, right?
They've been around look how long they've been around for. You could have bought them when we came to the U.S. in 1984.
Wow.
They were selling for, I always look at that, by the way.
So again, if you're watching later,
$1.40.
If you're watching later, this is all for Questline. We don't know much about this company, but we will look out the financials to see if it's a healthy company and see if it's a buy or not a buy, Paul. Shall we look at, what is the market cap for EcoLab?
$62 billion. So $62 billion. PE is negative. Wow. They lost $1 billion in the last 12 months. How is that even possible?
Oh boy.
So X on the PE, 8% profit margin.
Still
X
an X
also.
there. So with PE, folks, we want that less than 20, and we want our profit margin above 10%, which we're not doing well so far.
First off, how did they even lose money in the last 12 months? This has been the cleaning supply business world. Okay, that's already a red flag to me.
Benjamin says EcoLab owns this industry. We shall see. How about revenue growth over the past 5 years?
We have seen the EcoLab cars around. 13.55 to 14.9. Now remember, this is going to December of 2019. So if you want to look at trailing 12 months, that's about the same. Wow. I don't get this. This is weird to me.
This one stumped you.
Yeah, this one's odd. Like, how are they not making a ton of money right now?
Owen says, so many places closed, they don't even need cleaning anymore, Paul.
Is that what it is?
I don't know.
All right, so profit, again, $1 billion to $1.55 billion. Check mark there, but remember, in the last 12 months, they've lost a lot of money. They've lost $1 billion sometime in 2020. You need to understand why they lost $1 billion, okay? You've got to understand that.
Jeffrey's saying the same thing. Restaurants have closed, so they don't need to be cleaning. Maybe they were joking, but I guess people are serious here.
But if you look at, like, Clorox, and you look at all these other cleaning supply businesses, they've skyrocketed.
Yeah.
Right?
Andrew says they're huge in the restaurant industry, consequential loss. Okay. So how was revenue? I'm sorry, not good?
Revenue growth was there, but it's not and profit growth is there,
Oh,
but
both.
this last year has been a big loss. So you have to understand that.
Okay.
Shares outstanding, 296 million, down to 288. So check mark there.
All right, so they're buying back shares. That's good to see. How about current assets greater than current liabilities, Paul?
Current assets are $5 billion. Current liabilities are 3.1. Check mark there.
Okay. Free cash flow growth, the granddaddy of them all. We want free cash flow growth over the past 5 years, Paul.
So we had 1.18, so we'll call it 1.2, just to be safe, to 1.6. Check mark there.
Mm-hmm.
And then we have 1.2, 1.15, and 1.4. Averages around
1.3.
1.3 billion.
So 1.3 billion. This is free cash flow average over the past 5 years.
Why did they lose money this year? I don't understand how their revenue wasn't that much lower. That's the thing I'm going to tell people. And they lost $1 billion. There must be some. And the other thing is, there was a write-off. Because look, no, wait a second. Okay, so 1.3. Mm-hmm. I'm conservative now. I'm going to multiply it by 12. So what is that? That's 13 and 2.6 is 15.6 billion. What's the market cap?
EcoLab?
Yeah.
62 billion. So wait. Let me slow you down. Let me slow you down because not all of us are laughing because we don't know what just happened.
Guys, right now, their average free cash flow in the last 5 years is 1.3 billion. Even call it times 20, which I don't think you can justify that with their growth levels and the fact they just lost money in the last year. Multiplied by 20 is still 26 billion. We're paying $26 billion to get basically 5% of your return every year in cash flow. And they're currently selling for 62 billion bucks. Even take their last year and multiply it by 20, and you're still at 32 billion. Do you see why I do this exercise and do general ideas? Can I look at it saying, every metric we're looking at, giving them every benefit of the doubt, I'm still not buying them. So I just move on. Yep. So I'm looking at this saying, I'm not going to even look at this company until it's a lot lower in price. How much lower?
Yeah, tell us.
I mean, first off, let's go understand what they wrote off this year.
Make sure you guys are smashing that thumbs up. Henry Kirchanen in the chat, that's my 7-year-old son. I love you, Hank. And Gio said, dead meat, RIP to this company. He's over it already.
So there was a write-off right here. In the last year, there was some income from discontinued operations. So they had some big $2 billion write-off. So I'm okay with that. That doesn't bother me as much. I want to understand because it's not a very common theme around them.
Benjamin says it's not just chemicals. You hire this company to do health inspections for you. They have higher standards in county health departments. You will never fail a health inspection if you use them. You must love.
So they've never had income from discontinued operations, and in the last year they did.
Yeah, Benjamin says it's a great company. They basically don't have a serious competitor, but wow, that's expensive. Yeah, that is.
They had a $2 billion write-off right here. Right here, they had a $2 billion write-off. The good news is, guys, I love it when I see blanks everywhere or small amounts and then one big one. Because the problem a lot of companies do is, this is called income or loss from discontinued operations. What they'll do is they'll have a number every single year, and it's like, it's not, well, this is discontinued, so they probably sold off a division. Okay, so I'm not terribly against this, except for the stock price. So the stock price needs to fall considerably. How much? I'm interested in this company. You guys are going to hate to hear this because everybody hates hearing my voice, hearing my words on it.
Your voice too.
Yeah, my voice too. $80 or lower, and it's at 216.
Okay.
Hate me forever, kids.
Well, you could have bought it. Oh no, not even when it crashed in April.
Yeah, it didn't even hit there in April.
Yeah.
The last time it was down to $80 was, wow, 2012.
So to recap, this is EcoLab, and Paul says they're incredibly expensive at the moment. It's a no buy for you, right, Paul?
No buy.
No way. How about if we have questions in there, make sure you're putting in there questions. We will try to get to all of them, of course. Scott, we welcome you in. Jason, I see you there. And Milan. Let's get to...
Is Milan in Milan?
No, I don't think so. Maybe.
Sad.
Let's get to Kraft Heinz.
This Kraft Heinz is the deal that Warren Buffett did. I think there's a lot of debt on this deal. I'm not sure exactly.
Kraft Heinz, commonly known as Kraft. They make the ketchup and mustard that goes on my son's hot dogs on a daily basis.
By the way, I'm solely a yellow mustard guy. I can't have any other mustard in the world.
Not the
except for yellow.
ballpark mustard?
No, it's
Spicy
only
brown?
yellow. Only yellow.
Oh
Only
my gosh.
yellow. Nate, what were you gonna say? Only yellow.
Dijon?
Literally yellow mustard, and that's it. It's this weird thing. Like literally, I don't care what the mustard is. If it's not yellow, I'm not putting it in my food.
Okay, you can all rest easy. 120 people watching. Trader Mo is in the chat here to answer your questions.
He is? He got in?
He's here now.
He shouldn't be there.
He's done.
That's sad.
Yeah, we welcome everyone. The big news on my end is that yesterday, I watched 2 days ago. I watched Bobby Fischer. Searching for Bobby Fischer, the chess movie, and the young child. I just realized, Paul, that we didn't have the internet when I watched that as a child, and now that we do. So I reached out to the actor. His name is Max. He's in New York. And I said how I just congratulated him on making a wonderful movie 20 years ago, 30 years ago. And he messaged back, Paul. What a nice guy. So,
yeah, he said keep in touch.
Yeah, so we're going to have dinner soon, I assume. Him and I. All right, guys. Welcome, Paul.
Actually, can I do something else?
No, I was going to go ahead. But
I don't know if I want to do Kraft Heinz.
Then tell me, what are your favorite?
I kind of like T-Mobile. Let's look at T-Mobile.
Okay, let's do T-Mobile. Uh-oh. Arctic says, I love Bitcoin. Oh, boy. You better start. Oh, boy.
Well, he can love Bitcoin.
That's true. You can love it and lose your ass on it at the same time like most did.
All right, T-Mobile. I mean, the reason I want to look at T-Mobile is they're a very, very big cellular provider, right?
Yes.
So let's figure out how they look. $160 billion market cap, 43 PE, X, 6.5% profit margin, X, 60% gross margin. That's very good.
Okay.
So we have very expensive so far. Lower margin, high PE. We don't like that very much, and no dividends. So keep that in mind.
Okay. The mustard discussion really got the chat booming, but let's go back to what is revenue growth for T-Mobile over the past 5 years, Paul?
Over the last 5 years, revenue growth, 31 to 44 billion. Check mark there. Have they done acquisitions? I don't know. We'll have to find that out, but these are big jumps here.
Paul, if we get to 125 likes, people are saying you should wear a Tesla shirt or no pants.
Oh, I'll wear a Tesla shirt.
No pants at all, I would assume.
I definitely wear a Tesla shirt.
Okay.
I like your Tesla car. Would
you ever do the show in a skimpy bottom, some sort of bikini piece or leopard bikini bottom like Borat? No? Okay.
733 to 3.5. Check mark there. That's a growth of 5 times, which is 400%, not 500%. So it's up 5 times in the last 5 years. That's incredible.
This is profit growth? That is incredible. Okay.
That's a lot. Shares outstanding.
Shares outstanding. Ooh. We want this number going down, Paul.
813 to 854. X there. But let's go see if they made any acquisitions or anything like that, because their revenue growth was pretty heavy for a company of their size. We'll see how they did that.
All right, this is T-Mobile. We're moving on to our pillar number 6, which is current assets greater than current liabilities, Paul.
9.5 billion versus 19.5 billion versus 19.8. So an X there, guys.
They are upside down, huh?
They're upside down on their cash versus current liabilities.
How about free cash flow growth? Now, they bought Sprint, someone says. What does that mean?
Oh, boy. They have no free cash flow.
Uh-oh.
Are you kidding me? They've literally never had free cash flow.
Okay, so to a normal investor like myself, just
the last time they had free cash flow was 2012. So, guys, this is their cash from operations, and this is their capital expenditures. So, what we need to do, this is all negative. So it's an X. Well, maybe it's not an X. It's actually technically not an X. It's actually a check mark because it went from a $1.2 billion free cash flow loss to a $500 million. So it's a check mark for that. But the last one's an X. Capital expenditures have there's two different types of capital expenditures: maintenance and growth. So there are value investors out there that say you should only consider that part of it, because the maintenance capital expenditures are what you're spending to maintain the business so that it can continue going on. The growth money is the capital expenditures that you spend on like a building to go. Let's say you're a manufacturer, you're building a new factory to go create a new product line to go sell and increase your revenue. That they say should not be counted, which I understand that argument for it. Most companies don't break this out, but I'm just telling you guys that right now. But they have all negative cash flow. So from my perspective, I just can't even value this right now because I don't see. I mean, they're doing a lot of. Let's see their acquisitions here too. No. They basically grew organically this entire time. That's not bad. That's pretty good. So maybe they're just one of those companies like Amazon back in the day where they're just spending like crazy to grow. That could be very well be the case. But here's the thing. let's say they had zero capital expenditures and 100% of their money, 100% of their operating cash flow was real cash flow, was free cash flow, which would never happen. They're still selling for almost 30 times, like 25, 26 times free cash flow. It's still a big number. That's if every single dollar was going to free cash flow, which it never would be. Let's say half of it was. They're selling for 50 times free cash flow. Too much for me. So I'm not interested in T-Mobile. Me as an investor, the boring investor that I am, until they have consistent free cash flow, and at a lower multiple. So that's the unfortunate thing about T-Mobile. But this is a good example because we rarely see companies that are this big, this profitable, and on the books and have negative free cash. Keep in mind, our business always has negative free cash flow because we always reinvest more money back into the business to grow. That is our philosophy. We believe in it. We love it. We do it every single year. It's funny because my dad will say, how's business going? How's cash flow? I'm like, well, cash flow is non-existent. What do you mean cash flow is non-existent? And I always get some worried and go, Dad, we reinvest back in our business every single year. That's what we do. Look at this channel. This channel is a reinvestment, right? So Seth, what are you looking at?
We have some patrons who are requesting some stuff. I still have some ones of some companies that aren't really that well known. You know, it's a tough game, Paul. It's like our viewers want to find companies they know, but like the next one on the list is Kimball International, and it's news to me what the heck they do. It consists of 3 brands: Kimball National Hospital. It's a successor to world's largest piano and organ manufacturer.
Furniture manufacturing business.
Do you want to look at this?
Sure.
Their stock price is
all right,
dramatically down from where it used to be.
$440 million.
This is Kimball International.
Checkmark, PE of 12.65. Profit margin very low here, 3.64%. It seems to be a lot higher in the recent 12 months, but the last quarter was only 3.64 and a 3% dividend. So the 3% dividend is about $12 million a year. So right now we have a check and an X and a $12 million dividend. Remember, dividend's going to come out of free cash flow, so we want to make sure that when we calculate free cash flow, it's significantly higher than $12 million a year, so it's not a dividend trap.
Pillar number 3 is revenue growth over the past 5 years, Paul. This is for Kimball International Piano and Furniture Company.
635, 730, check mark there. Not big growth, but consistent. 635, 693, 704, 760. Oh, it's a little drop this year. So I want to see why. Oh, because this was, look at this. Their year ended in June of 2020. This was the peak of the pandemic. So I'm actually surprised it was only this drop right here.
Are we up to profit growth? Pillar
yep,
number 4?
Profit growth, 21 million to 41 million. So far, I like this, guys. Even though their PE is their profit margin is low, I like this. Number of shares outstanding.
Oh yeah, pillar number 5 is number of shares outstanding, Paul.
37.5 million, 36.9. Check mark there as well.
Profit is up, shares are down.
So we like this so far. Balance sheet.
Current assets greater than current liabilities is pillar number 6, Paul.
225 million in current assets, 98 million in current liabilities. Wow. Guess what, guys? Total liabilities of 130. So they had 230 in current assets. Subtract out, what was it? 130 in liabilities. That's $100 million. So they were 430. The company was worth 430 million. Whenever your current assets are greater than your total liabilities, you subtract this number out from the market cap. So you're essentially paying $330 million to this company. Wow. This is a big, big check mark. You know how much I love. We usually look only at current liabilities, but I always scan below and see the total liabilities. They have more cash on hand, essentially, than total liabilities. We love this. And the company's only selling for 430 million, which is essentially like you're buying it. You're buying a company for 430 million, and then their bank account has $100 million in it already. So you're taking over the bank account. So you're essentially only paying $330 million for the company.
I'm now interested to see the free cash flow growth, Paul. Pillar number 7.
Free cash flow. Okay, well, it's dropped a lot. So it went from 33 million down to 8 million.
Oh boy.
So that's an X, but let's go take the average. So 52, 24, 45, 44, sorry. So there was a big drop this year, but this is expected because it was June.
32. What do you think?
Yeah, this is a buy. I mean, I'm not going to say it's a buy, but this is a good one. This is one you have to go look into because look at it. You're buying it for $100 million less. I mean, it's essentially.
Wait. Before you jump there, show the final thing. So the free cash flow
So it was 32.
What multiple? Now this is
So remember, the company no longer is a $400 million company. It's 330. And you're getting $32 million a year in free cash flow, including their really crappy year this year, which is the pandemic. So you're basically buying it for 10 times free cash flow. If you take out the crappy year, you're buying it for like 8 or 9 times free cash flow. Let's see how the last 12 months is done in terms of free cash flow. Look at the last 12 months, including the crappy quarter, the crappy time. They've still had $28 million in free cash flow with a crappy pandemic in the middle of it. This is who gave this to us?
This
Lurch.
is Lurch, our patron.
Who's Lurch?
Gave us. Don maybe give some insight on that.
He's new? Oh, great job, Lurch. We like it.
Great find.
So I like this one more than I like Capri Holdings, I think. Maybe.
Daniel, this is Kimball International. They make pianos and furniture. They have 3 divisions of their company, and Paul is just straight up. Paul, you said you normally just not say this. This is a straight buy, but you're.
I shouldn't say it's a straight. Nothing's ever a straight buy.
Of course, but yeah.
Nothing's ever a straight buy, and the reason being is we don't know what the future of pianos are. Is it really? They don't even mention piano over here.
Oh, I got it on mine. Maybe different thing. World's largest piano organization. They have different divisions, and they're in Jasper, Indiana. My company sells to a company, an engine builder in Jasper. It's funny.
Look at this Yahoo article from the 17th. Hedge funds have never been this bullish on Kimball International. That kind of worries me.
Oh boy. Yeah. Gio, write this down. This is Kimball International. My son, he's looking to buy. Paul, he's got money to burn. And Scott says his dad's from Jasper. Yeah, Scott, I sell my DGF spray, the spray graphite, to a company, Jasper Transmissions and Engines, and they're one of the biggest rebuilders of engines and transmissions out there. So that's cool, Jasper. Great, Paul. That was incredible. We got a lot of great companies today. This is not typical for our show.
Yep. We won't do energy. Sorry.
How about
I won't do a REIT.
How about Cheesecake Factory?
Oh, Cheesecake Factory. Let me tell you my beef with Cheesecake Factory.
The menu has 7,000 items on it.
The menu has 1 billion items on there. How do you determine what you're going to eat at Cheesecake Factory?
Ain't nobody got time for that.
It's tough because I would imagine,
the food's so good too.
I wish they would just condense it down. Give me like one sheet of what you're really good at, but like you want Italian, you want Chinese food, you want the burger.
I don't get how they make that work. It's the most annoying thing in the world.
Dave says get their pork belly sliders. I do like pork belly. That's good stuff. I mean, look at me. I like everything pork. All right, Paul, let's look at Cheesecake.
You got quite the belly.
Let's look at Cheesecake Factory. What is the market cap for Cheesecake Factory?
$1.7 billion. No PE because they've lost money in the last 12 months.
Okay.
And no profit margin. They lost money in the last 12 months.
Okay.
So
well, we knew that was coming, right?
Yep. 2.1 billion. So the thing is, we got to kind of they got rid of their dividend. They used to pay a dividend. Now they got rid of it.
It's an interesting point. When did they used to pay it, Paul? When do you see
year.
that? Oh, okay. So that's not safe. I didn't, most people are.
Revenue, last 5 years, 2.1 to 2.48. When it comes to chains like this, guys, you want to figure out how much of this growth is because of the company's existing stores. So you want to look at existing stores sales growth year over year over year, as opposed to new stores. I don't know how many stores Cheesecake Factory is opening, how many they have. Actually, on the main page, it'll probably say how many they have. Does not say how many they have. Too bad. Right? Ah, well. So anyhow, profit. So this is before the pandemic, guys. 116 to 128. Check mark there. Okay? And then shares outstanding, 48.8 million down to 44 million. Check mark there.
Check mark there as well. The shares going down. Real quick, Paul.
Yes.
Guys, we see your questions there. We love it. Christopus has been watching this stream the whole time, and he keeps asking about a Chinese company, Paul. I don't think we'll be looking at that company, but we appreciate your support. He's asking for Momo, Paul. It's a pretty.
Okay, the reason I don't look at Chinese companies is there's always a lot of allegations around the accuracy of Chinese numbers. I don't mean it to be racist or anything like that. It's just there's been a lot of manipulation of numbers coming out of China in history. So I just prefer to avoid them. We have plenty of companies in the U.S. in which I'm going to enjoy.
Let's go to current assets greater than current liabilities.
Current assets, 411 million. Current liabilities, 540, which seems to be pretty spot on for restaurants. They tend to have less cash on hand than liabilities.
So that's an X for X for Cheesecake Factory. How about free cash flow growth for Cheesecake Factory?
Again, this is before the pandemic. But let's look at it. So we had, what is this? 92 to one. Why is my math going bad? 135, 138, 140, 143. So check mark there.
Mm-hmm.
And then we had 200, we had 116, and we had 185.
The average free cash flow over the past 5 years is 147, Paul.
Okay. What was the market cap?
1.7 bill.
All right. Doesn't seem terrible.
No?
No. It's on, what is that, 12 times? Is 170. So it's about 12 times free cash flow. You know, that's what we should do. Maybe instead of multiplying by a certain number, we should just see what the ratio is and see what the number is. You know, maybe this isn't so bad. The thing is, guys, you have to sit there and say, I always get worried about Cheesecake Factory because that's 30-foot high ceilings and no seats above. Now, I will say, have you been to a Cheesecake Factory lately? It's always a long wait.
I haven't noticed that. I haven't noticed that.
Oh, I've always thought it was a long wait, unless you go to like a really obscure time.
It's a nice place to eat. I mean, the
I
beautiful
enjoyed the
inside.
food.
Yeah,
Big glasses for my Diet Coke.
Their desserts are great.
Of course.
Dimitri, welcome. It says first time watching the show. You guys are taking my knowledge to the next level. Dimitri, I'm with you. I represent you guys because Paul came into my life 3 years ago and I knew none of this stuff. We've discussed this on the show. I still don't. Like people were telling me just buy stocks you like. So that's what got me into like the Amazon, into Apple. Most people have no clue about any of this stuff, looking at financials, let alone even looking at what the stock price used to be. So we're glad that you're learning. Yes, if you stay with us, you will learn a lot.
One thing I want to point out about Cheesecake Factory, 10 years ago, $340 million in long-term debt, 1.75 now. That's 5.5 times more debt. Now let's go see their revenue. Did their revenue keep up with that? So if their revenue was up 5.5 times, I'd say, okay, maybe that's not terrible. Let's go see. Their revenue over the last 10 years is only up 65%. So their revenue is up 65%, and their debt is up 400%.
Paul, what's the difference between revenue and operating revenue? Social distances, our gal from Toronto is asking.
They basically, so operating revenue is, so the extra, basically the same thing. Sometimes there'll be another revenue stream that's coming in, not from the operating business, and that would be a separate revenue item. You follow what I'm saying? So I'm trying to think of an example. I don't even know an example. Let's say it's, I really don't know. But the bottom line is, I always look at the top line. I just look at I should be looking at the total revenue number because I really don't care as long as they're bringing revenue in. But operating revenue is operating that business specifically. So again, their debt is up 400%. Their debt is up 400%, and the revenue is only up 65%. That's kind of a red flag for me. So remember, even though these 8 pillars are good, we still want to see where the revenue and debt comes into play. It's not something we've talked about a lot, but it's something we definitely need to consider.
If you have questions out there, we love you. Make sure you're smashing the like. We love you. Make sure you subscribe as we do this every Tuesday and Thursday at 1 p.m. Paul and I go live to talk about Paul's tight pants and
my pants are tight. My pants are tight.
And stocks like this. Paul, should we keep going?
Yeah.
It's almost 2 o'clock. When do you want to stop, my dear friend?
Oh, wow. Well, I don't know because I've been talking a lot today.
Mm-hmm. I was thinking about looking at Kroger, Paul. We haven't looked
at Kroger.
Yeah?
Yeah, we have.
We have.
I don't remember what I said about it, but we have looked at Kroger. It is one of our live streams we did Kroger. What's Bunge? What's Bunge Ltd? Based in Missouri. Global agribusiness and food company with operations along the farm to consumer food chain.
Paul, now they're flying in. People want to look at John Deere, Big Lots, Berkshire, Bunge, which is...
Oh, Big Lots is my big...
What?
Let's do John Deere.
John Deere. I love John Deere. Nothing runs like a deer. If you work for John Deere, contact me. I have a product for you. DGFspray.com is my product. I need to sell it to you.
Look at the stock price this year.
Oh, Lord. So right off the bat, you're not interested.
No, that's not true. It's just something tells me it's going to be very expensive.
Uh-huh. It looks expensive already.
It does, doesn't it? Okay.
This is John Deere. Let's go.
$85 billion market cap. 31 PE, X. 8% profit margin, X. 1% dividend. So they're paying about $850 million a year in dividends. So far, 2 X's, decent gross margin, 26%. They manufacture a lot of big stuff. They're going to be very reliant on the economy, agricultural equipment, etc.
Revenue growth over the past 5 years?
I imagine it's going to be very low. Maybe they made an acquisition here. 26 billion to 34 billion, check mark. There was an acquisition here somewhere, maybe a disposition, but the revenue has been falling the last few years. That is not a good thing. So we still have a check mark because it's growth in the last 5 years.
Profit growth, Paul.
So profit growth.
Pillar number 4.
1.5 billion to 2.75. Check mark there.
So far, so good. How about shares outstanding? You want this number going down?
Oh, this is why their revenue fell. This is the quarter ends in October, and obviously that included the pandemic. Shares outstanding, 315 million down to 313. So check mark there.
Keep going, Paul.
Balance sheet. Total current assets, 51.3 billion. Current liabilities, 23.3. Check mark there. They almost have enough money on hand to pay off all their liabilities. They're about 9 billion short. So nice job there.
How
free
about
cash flow.
Free cash flow growth over the past 5 years, baby.
And I love that this free cash flow will include the pandemic. That's what I like.
Why is that?
What do you mean? That's
Why would you're excluding it from restaurants?
Well, I mean, it's going to show still positive free cash flow even with that.
Okay, keep going.
Oh, but they haven't had free cash flow. Oh, jeez. 800 million to 4.8 billion. So check mark, but negative 400, negative 900, 0. Jeez, oh, Pete. What's our average? Why is that?
I don't know.
What do you mean you don't know?
I didn't do it. I'm looking at it.
I'll do it. Ready? So minus 100, minus 500, 4.3 divided by 5 is 860 million. Okay. So it's about 100. It's selling right now for 100 times free cash flow.
Yes. 100 times free cash flow. Oh, boy.
X. Guys, I'm not sitting there. I'm not looking at this thing saying, I mean, the free cash flow number is just insane. Why is it so up and down? Why do they have such a big jump in their cash from operations? Let's look at their operating income. Operating income. I mean, it's going up. Cash flow. Let's see if they spent money on acquisitions. Big acquisition there. Yeah. So guys, the other thing is they're like, they made a disposition here, or it was a net disposition. I mean, I don't like the fact that I don't know. I'm not keen on John Deere at this time, at this price. Am I interested lower numbers? Of course I am. The question is where. I don't know. Because their revenue is not growing.
Take home on John Deere is a big no. I
mean, look at them. In 2012, they did the same. They did higher revenue than they did in 2020. So again, just because they're not growing doesn't mean it's not worth something. It's just to pay 30 times PE and 100 times free cash flow on the average of the last 5 years. And of that average, they averaged 800 million a year, and 4.8 billion was done in the last year. That's just, things are not adding up to me.
Paul, I asked people where they're from, and now the Greeks are talking in some other language, some other alphabet to each other. So you guys keep that up. We appreciate the
Sputnik at the table, guys.
The chat. Paul, we're going to do ADM. This is Archer Daniel Midland. A lot of people are asking about this. This is off the request line from Patreon. Jeff has asked for ADM.
Major processor of oilseeds, corn, wheat. Why do we all of a sudden love the agriculture business suddenly?
I mean, just check. I skimmed the numbers. Give it a look and tell me your thoughts on this company.
All right, 27 billion. This will be the last company we do, and we'll just talk generally about things. 27 billion, 17 PE, X, 1.5% profit margin, X, 3% dividends. So they spend about...
PE's good, Paul.
Oh, I'm sorry. Check mark on the PE. I apologize. Check mark on the PE.
Good PE, right? Yes.
Yeah, profit margin is X. Dividend yield 3%. They spend about $800 million a year on dividends. Okay?
How about revenue growth over the past 5 years, Paul?
The revenue growth. 67.7 to 64.66 X. But they are uptrending the last few years.
Oh, Instatortoise says, is there another place for patrons to request and also chat in here? Sorry, I don't understand.
1.8 versus 1.4 in profit, X as well.
Oh, no, Paul.
So we have a lot of X's going on here, guys. And it doesn't even include the pandemic stuff.
Oh, boy.
Yeah, number of shares outstanding, 618 to 563. That is a check mark.
Okay. How about
balance sheet?
Current assets greater than current liabilities.
22.8 versus 13.91. Boom. And they almost have enough to pay off all their liabilities. So this is a good thing.
Good. Let's do free cash flow, Paul.
Oh, boy.
Uh-oh, he's laughing already.
They haven't had even operating cash flow at all in the last 4 years.
What does that mean again, Paul?
Their cash from operations are negative.
Oh, okay.
Yeah, so we have to subtract even further out. So this is a they went from free cash flow to non-free cash flow. It's an X, and then another X. I just don't. I don't get it, guys. I really like free cash flow. So when I see negative free cash flow for many years, let's see how they're doing the last 12 months.
Tortoise, I'm sorry, I didn't see you as a Patreon. Yes, Llewellyn, make sure you help the Tortoise and make sure we get him where he needs to go there with his questions.
Yeah, so I don't look. I'm going to pass on Archer Daniel. I just don't. They haven't had free cash flow. There could be a very good reason for it, but I just look at it saying, nah. I really want to see if I'm going to wait for the stock price to go to a certain level. I want to see if there's at least they're going to build my balance sheet up better. They're going to pay down debt, decrease the number of shares, or increase my bank account. That's what I want to see in a company that I'm investing in.
Paul, I'd be remiss if we didn't just do one more because dear Dom, our patron who's been watching the show now for an hour, wants to see Amgen, and I would too.
Amgen is a leader in biopharmaceuticals. Flagship drugs include Red Blood, Epigen, and Aranesp, and some other weird names. Okay, so with drug companies, the great news is they have patents. When they have patents, they own that market. When the patents go away, they lose that entire market. So the big thing is there a good pipeline for this company? That is the qualitative aspect that I'm not going to look at on this analysis. We're going to look at it as is right now. What was the company the other day we looked at where 50% of the revenue came from Humira?
That was Pfizer.
No.
What is it, Don?
Wasn't Biogen.
Oh, sorry.
Whatever it was, the whole point is, and they're losing their Humira patent here shortly. So that 50% of the revenue is going away, or it's going to be decreasing drastically. So for Amgen, we want to pay attention to this stuff. So $130 billion company, 17 PE, check mark, 31% profit margin, check mark,
okay.
3% dividend. So their dividend is 1.2 times 3. Call it $4 billion just to be conservative. $4 billion.
Check, though?
Check.
How about revenue growth, pillar number 3?
It's only 2 checks. Revenue growth, 21 to 22.2, check mark.
Profit growth, Paul, pillar number 4, baby?
Profit growth, 6.9 to 7.8, check mark.
Wow.
But as you guys can see, these are not big growing. It's not fast growing company. They went from 20 billion to 22. AbbVie was the one that had Humira. So these aren't big, fast-growing companies. So you got to remember that when you look at your multiples. If they're not growing fast, you cannot pay a big multiple because you have to get your return based on the current cash flow that's coming in.
So listen, guys, I love you. It's funny. I'm trying to host a show, listen to the comments, and keep Paul in line. And so, Paul, I said what we were talking about, what company that was, and like we said, this is kind of like our last one, and then 18 people in a row wrote AbbVie, and I'm like, what's going on? Everyone all at once wants to look at AbbVie. So sorry about that. Yeah, we did that last week. Keep going, Paul. We have 4 check marks in a row for Amgen. Keep going.
758 shares, 605. Check mark there.
5 in a row. Let's
go. All 5?
All 5, baby. Let's go to current assets greater than current liabilities.
22.7. versus 9.95. Wowzer, that's good. Okay. Great stuff. And the other thing I like about it is their inventory is not a big chunk of that number. That's a big plus for me.
Amgen. Let's look at free cash flow growth over the past 5 years. Baby.
This is what I love, guys. These drug companies have amazing free cash flow. All right. So they went from 9.1 billion to 8.5. So it's an X there.
Uh-oh.
So let's check out the rest of it. So 9.6, 10.5. 10.6
plus 8. What's the last one, Paul? 8.5,
10.6.
Got it. I got it. Divided by 5 is 9.6. Market cap's 130 billion.
This is not a fast-growing company. 130 billion doesn't seem bad to me. 13 times does not seem awful. So I like this. 3% dividend was $4 billion. They can easily afford that.
Mm-hmm.
Okay. I like this. What you need to do now is look at their pipeline. How is their pipeline relative? Do they have this revenue stream growing? Is it staying the same? What are they doing to make sure that it's maintained? They made a big acquisition last year, $13.6 billion. What was that? Let's find that out. They did big acquisitions earlier in the decade. So maybe this acquisition had something to do with making sure that they keep their pipeline growing. But I kind of like this. The question is, how do they fund this? Did they fund this? They fund this with financing? I don't know. Either way, I'm not opposed to Amgen.
Social Dancers asks, when a company's current assets are greater than total liabilities, will the Everything Money website app take that into account with subtracting their total from the market cap? Listen to this gal talk.
That's a great question.
I love the fact that you answer that, because I asked that question, because it's a great question, and the verbiage you're using means you've been following us for a long time, which we love. Go ahead, Paul. What do you think?
It will not do that, but maybe what we'll have to do is have it. Yeah, maybe it can. What it will say is probably like a note next to the thing saying the total current assets are greater than the total liabilities, so by amount of this. Because at the end of the day, current assets are made up of receivables and inventory, and those should never be valued 100% of their value. I mean, a liquidation event, you're never going to get 100% of that. So I don't know the exact number we should do, but we'll definitely notify you, hey, in this situation, this is a super check. This has more current assets than all liabilities. We will want to make sure you know that.
So today, Paul's Power Picks. Kimball International, you're in love with.
I like Kimball.
Amgen, you're in love with.
I like Amgen. I like Capri Holdings too.
Today we did Capri Holdings. We did SpartanNash. We did Leggett and Platt. We did EcoLab. We did Heinz, T-Mobile. We did do a video on Chewy this morning. We'll do Chewy's coming out in the next couple days. We did Cheesecake Factory, Paul. We did Archer, Daniel, Midland, and Amgen. We're all over the damn place. Final thoughts before we close up shop today. We will not be doing a live stream on Christmas Eve, Paul. Wouldn't you assume that?
Sure. I guess not. We'll put another video up. I want everybody to know, I get a lot of comments from people about where the market is. Every value investor I know, every investor that's reasonable, had good long-term success, sees that the market is very expensive. I want you guys to stay dedicated no matter what happens in the market. If the market falls in half or whatever it is, just remember that listen to Uncle Paul. That'll be a good time to buy. I'll be putting the few people out there talking about lower prices are better for everybody.
John said we skipped Heinz. Did we skip Heinz?
Yeah, I didn't do Kraft Heinz.
I'm sorry, John. Yeah, you're right. Paul,
I didn't want to do it.
You know what's hilarious, Paul? I would say from a very personal standpoint, we talk a lot about my sons who are learning from you. They watch the show. The market was down yesterday. I lost a ton of money, and a lot of things were down. And Gio, his eyes just lit up.
Did they really?
Just lit up. Yes. Let's look. And he lost $160 for a 10-year-old kid yesterday. That was a big loss, and he was fired up to look at this, and so he'll be fired up to hear about some of these companies. So
the whole thing is, I want you guys to remember that this is a long-term process. It seems boring. I'm still part of the Everything Money website / app will involve some momentum trading. I'm going to do momentum trading. Just remember that it's not just this, let's get money today. Let's build a portfolio of good companies. One of the things that the website will let you do is put all your companies in and how many shares you have, and it'll tell you basically what your holdings are generating in revenue, profit, cash flow, assets, and all that stuff every single year. I want you guys to know that, so you sit there and say, my job is to buy a good package of 20, 30, 40 stocks that have very good multiples and very good growth potential, or low enough valuations, multiples, that you can justify slower growth.
Thanks for joining us. That was incredible, Paul.
Thank you, sir.
We jammed. Please make sure you smash that like button. 111 likes, Paul. As soon as we jump off camera, we'll be freaking out about the numbers today. It's incredible. We've grown double in subscribers the past week, and it's all due to you guys. So we appreciate your time. Visit the Patreon below if you want more access to us. We appreciate our patrons. We love you in the chat, and we'll see you on Discord. Thanks, everybody. Thanks for joining us, and thank you to Uncle Paul for all the knowledge, bro.
See you guys. Christmas.
See ya.